as entrepreneurship has become more accessible through the internet and like social media, there's obviously a glamour that comes with certain activity that isn't potentially a real success metric.
What does success or what does wealth look like to you? And I think people aren't clear on that, and they are most of the time looking at what other people are doing versus what they actually doing a deep dive into what they actually want. And we've been going because of this potential cap raise of doing a lot of that deep dive, like, do you actually need that much?
How much of your soul are you willing to give away in order for you to receive that capital, right?
Exactly. And I think there's so many of those stories and so many different podcasts or whatever where founders regret those big cap raises and giving away their company. Even Steve Jobs is booted out of his company.
Yeah, but before you know it, right? I think it's about like partnering with the right people. Hello and welcome to another episode of Ways to Wealth. Today I am joined by Dan. Dan, why don't you give us the TLDR on kind of what you're up to and what you're building?
Yeah, so about a couple of years ago, I've started a sportswear business called Fanti Sport, and we're sort of redefining what sports looks like. At the moment, we're focused on golf and looking at the apparel space in golf. But I think long term with what's happening in golf with it booming and it being so saturated, we're looking at what's beyond that, from experiences all the way through to like how do we actually solve some of the problems that are happening when it comes to performance in the world. So yeah, it's a good little start right now, and we're trying to figure out some things on funding and people coming into the business, and so there's all sorts of things going on at the moment. But yeah, it's a sports performance business that we look at how do we use design to solve some of those problems.
Specifically like around kind of clothing.
Clothing right now, I think it's sort of we've got to do one thing at a time. I'm always sort of thinking way too far in the future, but yeah, at the moment it's just apparel and experiences.
Right. So merging that and creating a bit of a brand experience around the product.
Exactly.
And then kind of having it there being a vibe with what, with the output that you're also doing, which is creating great product.
Yeah, exactly.
I mean, that's kind of the future of actually success and building like distribution yourself, because I think for a long time, there's always been publishers. There were publishers, then there were basically ad networks. And now there are platforms which allow you to ultimately be your own distribution network. But that takes a long time to build, a lot of effort and a lot of consideration.
Yeah.
And actually a lot of apparel business they're often, because it's quite good to know about the unit economics, right? You can kind of buy eyeballs off of ad networks quite easily as long as you know your numbers, right?
Yeah, I think when I was initially thinking of this concept, which was almost 15 years ago now, so we've been very slow to go to market. It was always sort of media company mixed with apparel. There was never anyone solving the problem of the apparel that we wanted in this space. And I've grown up playing all sorts of sports, from basketball, cricket, and eventually came to golf. But to your point, I think every brand now has to have that media arm, and the biggest ones in the world, they start with the celebrity or the that media channel, and then they sell a product. Mr. Alice, Kim Kardashian, the best examples of it. So we don't have those.
No.
We always thought we would create original content, which we've been slow to create. But I think still that'll be the future of how we sort of build our business.
Yeah. Okay. Yeah. Cool.
Yeah.
I mean, we were talking before the pod that you've kind of done a bunch of different stuff. Were you always like entrepreneurial? What was the kind of driver, and was there any catalysts when you were younger that like made you want to kind of get involved and kind of get, I guess, risk on from a kind of building stuff perspective and trying different things? What's the kind of driver?
I don't know where that came from. I've always been super, super competitive, especially when it comes to sports. My parents are very entrepreneurial, so I think I've sort of definitely got inspired by what they did, and had multiple things going on, from whether it was owning an agency and a restaurant at the same time. So I think that I definitely have always wanted to own my own thing, and I've done that. I've got no clue where that's come from, because anyone that's done it knows how hard it is.
Yeah.
And I haven't reaped the rewards of doing my own thing yet. But it's something that someone that doesn't take authority well and wants to just see what I'm capable of. I think it's a pretty exciting space to be in. But yeah, I'm not sure where that sort of bug came from, because we sold Christmas trees and t-shirts when I was young. And, you know, in my first business, when I was sort of early 20s, we sold vitamin chewing gum. We grew that quite big and too fast. We did everything wrong. Then we lost all our money, and I had to start again and went into the corporate world for a long time. But while I was in the corporate world, started another business, trampoline parks. And then towards the end of that, we started Fanti Sport. So yeah, there's always, I like multiple things going on. But yeah, it's always tougher than you think.
Always takes longer, I think.
Longer, yeah.
Yeah. Interesting. So just with you mentioned that you did everything wrong with the vitamin gum. Now gum is getting huge now.
Yeah, it was an amazing product, like a really amazing product, because we had vitamins in the coating, which is actually a far better way to take vitamins than a pill, because it absorbs much quicker.
Right.
So we got it manufactured in the States, and I think one of the biggest things we did wrong was we made ourselves look too big, like a big corporate company. Whereas, you know, like Charlie's, for example, made themselves look like the underdog all the time. It was young guys going against the big dog.
Yeah.
And I think if you saw us in the supermarket, you assumed we were coming from some big corporation, but it was two young 20-year-olds having a crack.
Right.
And we grew it really fast. We had 2,000 stores within a year or two. You know, 7-Eleven across Australia, Woolworths here. Yes, which was another big learning, was if you grow too fast, it sucks up all your capital, and that was another big learning when you
Had to raise capital for that one, or did you just
all self-funded?
Yeah, self-funded.
Yeah, we split it between me and one of my oldest mates. We kind of, I think we put in like 170K each, and then burnt through that within, you know,
Pretty cool.
faster than.
Yeah, right. So it's like a bit of a flash in the pan kind of.
Yeah,
Some success, because obviously to get do the things that you're doing, obviously to actually get into supermarkets and stuff and get that shelf space, obviously a little bit different from maybe the US, where it's very competitive and there's a whole vibe there, right?
Yeah.
But to just get in the stores here would have been a big challenge, especially back in the day.
Yeah, we didn't find it that hard. I thought we did a really good job of branding and marketing it, and then like 7-Eleven came to us for invites. We knew Woolworths was quite tricky, and some of the meetings we had early days with the category managers of say Woolworths was always really interesting to us, and how to, you know, if I did it again, I'd know exactly what to do. But they kind of ask you, you know, what are you going to do for us? And we're always like, I don't know what you mean by that. And when I look back, we probably spent more money being in Woolworths than we actually paid in there, probably from promotions, you know, keeping stuff on shelf. And yeah, it was really interesting experience.
That is interesting, because you wouldn't suspect that, perhaps.
Yeah. I just think I mean, you know, the old saying, sales cures everything. I just don't think our sales kept up with
what you were doing.
Yeah, exactly. And then we also got to a point where we were waiting for product to arrive. So you're having to fund that. And then, you know, it's always a money cash flow game. And we just kind of ended up running out of cash. But the big thing we tried to do was, if you know much about chewing gum, the actual core of the product's not necessarily that good for you. I mean, you don't swallow it, so it's not terrible, but we got to a place where we wanted to be all naturals. Yeah. And we were looking at ways to do a natural gum base, all of it natural from start. Like, it was basically a natural confectionery range with vitamins in it. And we were trying to get gum base from Brazil to Italy, and that was the point where we were like, this is too hard, and we kind of just ran out of energy. And I actually wanted to keep going, and my business partner was like, I'm done.
Tapped out.
Yeah, tapped out. This is too much.
Yeah. It's hard, like, when you get to a situation where the outcome has to be binary. You know, like, you always we have a saying in our business that one of our principles is to live to trade another day.
Yes. Well, you only fail if you give up, right?
Yeah, basically. Yeah. So being able to position yourself in an environment where you can play the game the next day, I think it's always for us now. And over time, as I've learned through building business, innovating on product, you know, participating in markets, you know, it's all about, you know, you kind of, as long as you can continue to play the game and you don't get out, then you basically have almost infinite upside.
Yeah. I mean, we at the moment with Fanti Sport, you know, weighing up raising money, and that goes, okay, well, cool, how big do you want to be? You know, so it's like, do you just want to go at your own pace and have a lifestyle brand, or do you want to build something massive and have investors knocking on the door? And I think it's a really good conversation for people to have of like, do you want a 12-person company with maximum profit, or do you want this huge business where you have to deal with all these problems and all these people? And
Well, and what's the length, right?
yeah,
How long? Because I'm always telling my kids like about, you're running your own race. Stop talking, like, stop comparing yourself to your sister or your brother about what they're getting, because you're in a different game,
yeah,
right? So stop, and they can have something that you can't have at that moment in time.
yeah,
That's just the way it is. That's life.
exactly.
And you might want a big business if you want to grow it slowly and don't want to give up capital, right? If you're willing to play the game for 40 years or 30 years, right? But you also might want a huge business and you only want to play the game for 4 years and you want to sprint, right? Are you do you want to do a marathon or do you want to do a sprint? And I think that as entrepreneurship has become more accessible through the internet and like social media, there's obviously a glamour that comes with certain activity that doesn't necessarily end up in isn't potentially a real success metric.
100%.
So we can get kind of fascinated by these ideals, right? Like when I built my gaming business, Uproar, which we grew to, hundreds of thousands of users, I wanted to sell to Amazon for some reason, right? Because they bought Twitch. But I didn't focus on like
What you wanted versus you were looking at.
what I thought, or what I've thought was success in startup and innovation and building something. And we still did great things and we had, explosive success and growth, but it wasn't a sustainable business. And the whole industry wasn't sustainable. So it's quite interesting now to reflect on seeing so many of these attempts that aren't kind of sound, and some of them work.
What does success or what does wealth look like to you? And I think people aren't clear on that, and they are most of the time looking at what other people are doing versus what they actually doing a deep dive into what they actually want. And we've been going because of this potential cap raise of doing a lot of that deep dive. Like, do you actually need that much, and you actually want out of your day, and
how much of your soul are you willing to give away in order for you to receive that capital, right?
Exactly. And I think there's so many of those stories and so many different podcasts or whatever where founders regret those big cap raises and giving away their company. Even Steve Jobs was booted out of his
before you know it, right?
Yeah.
I think it's about like partnering with the right people.
Yep.
Like we have a group of shareholders, and angels, friends, family, professional investors, but they're all partners with us for the long term, and they despite it not being positioned as a venture-backed business, they backed us with the idea that this is going to be something that could be intergenerational.
Yeah.
And it's about like having the kind of, the foresight to go, actually, this is how I want to play. And I know that some people are not going to like that. Some investors don't like how we kind of talk about our business because it's like, well, where's the exit?
Yeah. Yeah. I mean, I'm obsessed with finding a group of people that you want to work with day in and day out. Because
for sure.
Ultimately, if you're with your work colleagues more than you are with your family.
Yeah, for sure.
So, and that's really tough. I'm sure you found with finding the right people in whatever businesses is always the
co-founders.
Co-founder.
It's interesting. Yeah, I had a few. I think the alignment around ambition is huge. Like how far you're willing to go.
Yeah.
What each of you perceive hard work to be, even potentially. And different ebbs and flows, and also you got to help your team when they're going through a lull, right? So it's like picking the right people to work with, and then knowing that there's going to be volatility, and you might have to pick up the slack for some of your team at some point.
Yeah. Yeah, one of my good learnings from when I was working at Les Mills is hiring people that were too similar to myself.
Yeah.
You always think that's a win, but it's always the wrong decision.
Yeah.
Like you want people that are almost completely the opposite to you, and can do things that you're obviously not good at. And it was a real good learn. We had a couple of them, and it's just always a bad decision, I think, you know. But yeah, that conversation up front of like how hard do you want to work when you're building something probably doesn't happen enough. And you know, to my point around vitamin gum, like I'm someone that will pay to the bitter end, but my partner Josh, I'm sure he doesn't mind me saying, like he he didn't want it, you know, he didn't want to fight that fight. So but having that up front of like how far we're going to push it, because I think that's the funnest part when you've got momentum with a business and you're all high-fiving along the way. I think that's the best part of what business is all about. Whether you're at the point of profit or anything, as long as you're feeling that motion.
Yeah, the all in mobility and momentum is like the lifeblood of businesses.
Yeah.
And then you get that kind of trough of despair, and
Yep.
that's where businesses basically go to die, unless they can basically continue on enough time so that they see that momentum again, right? Because you know, you see all sorts of businesses out there that started as one thing, went through a trough of despair, and then ended up X amount of billions of dollars. Like Airbnb is a great example of that. They went through a bunch of iterations, and they had to like sell cereal for one of the elections to get by. And that talks about, you know, living to trade another day. Being able to play the game for another day gives you more options. Um, but yeah, like super important.
Yeah. Yeah.
Mm.
Yeah.
Cool. Interesting. So then the trampoline business, these both seem like quite capital intensive businesses, these first two.
Yeah. Yeah. That was, I mean, the biggest learning from Uptown Bounce was, you know, disaster for so many different reasons. An old business partner of my mum's found this space in Greyland, which was like an old movie theater. And he actually wanted to do, I was working for Les Mills at the time, and he wanted to start a kids gym in there. And which was an interesting concept, but I knew coming from Les Mills, we were starting to try and get a kids program off the ground. And I knew the struggles we were having, especially with schools, and it's actually really tricky to deal with schools and things like that. So I'd just come back from Aussie and dealt with a friend who had been opening these trampoline parks and just sort of printing cash. I was like, right, that's what we should do in here. And we had this interesting space, found out where to get it manufactured, and yeah, it cost.
Yeah.
We actually we build out as a build out, yeah. And then the biggest thing is just dealing with the people who are in the buildings, you know. And I think like you get good ones and you get bad ones, and we had some disasters toward the ends, and we had some really amazing landlords, and we really let them down, which was really unfortunate. We had some assholes, and that's.
So you had multiple
Okay, we had 3 locations. We had a little one in Greyland, and that was cranking because we had a nice little model there, and mums. And then in our mind, we're like, bigger means mad outfit. Yeah, we built one in Avondale, and just down the road. And as we were building one, our competitor built one just up the road, like, you know, 300 meters. And then we had one in Wellington as well, and we could never quite figure out why that one never got off the ground. But
the grey limo was.
It was a good little model. Yeah, it was making money.
That's interesting, right? Because there's a decision tree.
Yeah.
And it's, yeah, sometimes they're one-way doors. And obviously once you make a big investment,
yep,
you're kind of stuck.
So we got off the ground with next to nothing. For like your capital question, it wasn't massive. So I think at that time we had a really great brand.
Yeah.
And I think we could have sold a brand with a profitable business really quickly. You know, like those people that build a cafe out quickly and then sell them. I think that was probably the model for us. Someone with a bit more capital and just taking the brand and done a bigger thing that we couldn't execute properly because we probably didn't have enough capital.
Right. Or like playing in that niche space of kind of suburbs, right? Like Grey Lane could have gone to like, I don't know, like a Hillsborough. Oh, Hillsborough's got.
Yeah, we looked at Hillsborough, funnily enough. We were planning to build one.
You know, whereas Avondale's kind of quite a central location. It's big, it's industrial. You're going to get lots of competitors.
Yeah, I think it was the model for us was probably like the more affluent suburbs. We had the catering, we had better coffee and better food. You know, when you normally go to those kids' places, they had always like crappy food,
For sure.
button coffee, and so that was awful at the time, but some amazing learnings. And I'd hate to tell you how much we lost, and we had to actually sell my mum's, our childhood home to get rid of the final parts of debt. And
really? That sucks, man.
Yeah, and what was all learnings, but
what was the biggest learning?
I think the biggest thing of the first two businesses is to make sure you're doing something that you really, really know you're going to wake up at 5 in the morning and be excited by. You know,
Do you think that that wasn't the case with the second one and the first one?
I think definitely, dealing with supermarkets and FMCG is a tough grind,
Yeah.
And I think the trampoline business was that all work. It's like I think again using a restaurant or cafe analogy, you need someone there all the time, and for those to work, you need an owner operator in there.
Yeah, right.
But I mean the learnings with vitamin gum was make sure your margins are right, make sure there's a brand that people can stand behind, and don't make yourself look too big. Don't grow too fast. It was like get money. That was actually one thing I learned from one of our owners at Uptown Bounce, was like just get this thing trading as quick as possible. But yeah, the biggest learning by far was like making sure you're doing something that like gives you the energy. At the core of both of those businesses, my kind of deeper why, which is like I hate the term, but human optimization. So like obviously vitamin chewing gum was a better option for humans.
Yeah.
And then trampolines are actually incredible for kids too, like out through the limbic system. I mean, I obviously ended up working at Les Mills International, and that's the gym game and health and wellness. And now that's what we're trying to do with Fanduel Sport as well. So at the core of all those businesses, it was meaningful, but a lot of the day-to-day wasn't, I didn't have too much day-to-day at Uptown Bounce because I had a full-time job, but the other one, it was just, and it becomes unmanageable when you've got too much going on as well,
Yeah, too much liability, right?
Yeah.
Kind of often comes down to leverage as well, like, and just their struggles around managing that.
Yeah.
Because it means that there are circumstances where you can't play the game any longer, right?
Yeah.
And that's a big problem. But now you're kind of in a new space, a higher end space, and you're in an area where you can basically sell anywhere in the world. I'm assuming, realistically. So, but I guess a big part of what you're thinking about or wanting to do as well is experiential.
Yes.
So how does that like live together? Like this kind of idea of building like a kind of apparel brand, but also like there seems to be a real strong focus. And when you talk about the brand, you're actually more talking about how do you have these experiences in golf specifically, but potentially other things later.
Yeah. I think it's what's the best way of putting it? I think it's with we again off camera we were chatting about AI, and I think with the AI coming hot and heavy, I think we're never going to want to watch robots play sports. We're never going to want to watch have a robot experience sport or wellness for us. Nature's more and more important. So I think if you can combine all of those things into what golf as our Trojan horse is, there's so many benefits of like sunlight in your eye and walking 10,000 stairs and the mastery of it. And so how can we sort of put some fuel on the fire when it comes to the experiences that we provide through not just for, like golf tournaments or whatever it is, but through our product? How do we solve real problems with our product? And then even through the storytelling and content that we do, like how we providing an experience that's not just like forcing something down someone's throat, which I just, makes me sick. There's so many brands just turn on the meta ad engine and force something down someone's throat. So yeah, I think like how can we incorporate all of that, and a retail experience is part of all of that as well eventually, and own stores, right? And that wouldn't just be like clothing stores. I think how can we redefine what that looks like eventually? And I'm obviously getting ahead of myself, but I think we're going to want more and more connection, as loneliness is through the roof right now, and anxiety, depression. We're all doom scrolling and spending, if we add it all up, our 200 days a year on our screens. If we work 8 hours a day on our computer and then go home and doom scroll for 4 hours, we're just rotting our brain. So how are we, through our brain, taking people offline, and connecting more, I think is a part of our purpose.
Yeah, that's really cool. And I think that like I've seen from investors I really like, definitely doubling down on experiential or brand plays.
Yeah.
I've seen a lot of investors kind of like tech investors, for example,
Yep.
especially recently buying more and more sports brands and things like that because their thesis is that, and these are online natives, right? These are people that have built their wealth actually from building online platforms, like the co-founder of Reddit, right, who recently bought a sports team and
It's Barina's husband.
Yeah. And obviously he's married to her, so that makes sense that he's now getting involved in sport. But, he co-founded Reddit. He built a whole online community, like one of the biggest in the world, if not the biggest potentially. And he was a big kind of gamer, so he played a lot of like World of Warcraft, and he would have been in the online world. And now he's obviously transitioning and investing in experiential and sport brands, and like brands that are human, things that are human. So the thesis is that because of AI and technology, people are going to want more human activities.
Yeah.
And we were talking about kind of the interesting kind of play around kind of individualized sports, or sports that you can actually enjoy without necessarily needing someone else or a lot of other people.
Yeah.
And so, golf has become much, much bigger and much more relevant in recent times, I think. Jiu-jitsu and grappling, MMA, poker, all sorts of sports that are kind of quasi alone but communal, right? Like with jiu-jitsu, you do need a partner. Golf is obviously better when you're playing with other people. Hiking, CrossFit, all of it's kind of individualized, but with a community, right?
Yeah. And I think that's the thing with what I'm talking to is community, and how do you build with religion coming down and all these other things. I think people are craving, whereas like run clubs are now.
Yeah, they're doing really well.
I think what churches were is now for other people. That's what a run club is, and so are golf clubs, and so the sports club thing is.
Well, you're also seeing a resurgence actually in people going to different religions, back to different religions, right? You're seeing you saw a shift, like almost like a mean reversion now back towards faith of some sort.
Yeah, and it's hope, and I think it's it's because everyone's craving community, and I think now we know through fact that community is one of the key indicators of longevity.
Yeah,
we have it.
Yeah, for sure.
Which is a massive. If you look at those Blue Zone documentaries, it's all diets are different, but the similarity between all of them was community and the connection.
It makes so much sense.
It does. I think. What do they say? Loneliness is
like Buffett, right?
Yeah. Exactly.
Buffett like eats Macca's every day, and he's like 99, or he's like not 99. Charlie Munger was 99 before he died, but Buffett's old, and you can tell he's old now. Like he's really deteriorated over the last kind of couple of years. Like
he clubs, doesn't he? And
yeah, man, yeah, totally. He's in that inner sanctum community. He's always been around people, and he had the benefit of having millions of people that loved him, right? Like just from afar, like he's adored because of.
It does feel like if you compare him to say an Elon, it's sort of a stress-free approach to making money. It seems like to me,
I think there were times, but yeah, you're right. Like a more kind of reserved approach. Right?
Yeah. I don't know. They always seem pretty relaxed about it. Or most of the time, which most investors are, is in research, right, and reading. And I think it's like, I guess when maybe he realized early on that what's the point of being stressed about this, and market swings and.
Well, I think because he was buying to buy a business and own a business, right? He was actively trying to avoid speculating, especially once you had the intelligent investor and got into kind of value investing.
Yeah.
He basically made the very big call that that you shouldn't bet against America. So, and that's potentially a bias as well. Like he just put the stake in the ground and said, I'm going to back America.
Yeah.
And I'm going to be net like long America.
Yeah.
As my base. And he's the largest owner of treasuries, right? So he is the Mr. America.
Yeah.
Yeah. But yeah, like he owns businesses, so he doesn't care if the prices swing, because he's buying them thinking that he has a margin of safety and that they're strong businesses. And he says that like stocks are extremely dangerous in the short term, but extremely safe over the long term, providing obviously the business is sound.
Yeah, and I learned that the hard way in COVID. I pulled a whole heap of money out right at the bottom.
Oh yeah.
Yeah, right at the bottom. So kind of a good, young enough to rebound, but understand what I was investing in at the time, and knowing that you just never, like, why would you ever take your money out of the market, Because I was always like, it's got to get worse from here. It's got to get worse. And then obviously it went on the period that it did through COVID.
Yeah, because they've printed loads of money, and then well, and it depends what you owned as well. But yeah, I mean, like there was a huge inflection point of printing of capital, and we're now dealing with the kind of consequences of and trying to re-understand what money is, what the value of money is. People are trying to now move away from money, and they're trying to find other stores of value like gold and like Bitcoin.
Yeah.
And that has, that kind of constant demonetization or devaluing of currency has created this kind of trend around kind of owning these assets. And that's somewhat psychological, right? Because actually what it is at a fundamental level is I don't believe in the capital that I have in my bank and that I'm earning.
Yeah.
And I'd rather have it somewhere else. Like that's the kind of that's the behavioral like decision bet, like kind of vote, right? People vote with their dollars. And that creates mispricing.
What's your opinion on property? Because I'm in the place right now where I'm just like them bloody money pits, like potentially like sell the house and put a lot of that money into business, and the return is going to be so much greater. And people, especially in New Zealand, people's focus on it's all set up just to buy a property, and you really look at the returns long term on property. I'm like, it's pretty poor.
Well, I think it's an interesting dynamic, right? And I am probably one of the biggest bears when it comes to property, right? So I've always been barking on about, this property market in New Zealand is obscene and like it just doesn't make sense, especially through 2019, 2020, 2021, 2022.
Do you own a property?
No.
Yeah, all right.
But I don't like debt. So I just avoid debt, and I think that that's the easiest way to play the game.
I think it's such a good point that people don't understand the debt. Like some people are really bullish on debt and like to fund do. But I'm kind of starting to get to a place where I agree with you of like, it's so, to get ahead, you need so much more,
Well, it cuts both ways, right? So it works really well sometimes, and when it works the other way, it's terrible. You can't hold on, potentially. You might be forced. You never want to be put in a situation where you have to sell, right?
Yeah.
So I'm the biggest bear when it comes to property, because I think ultimately very ineffective asset, not very productive, it requires debt often, and the way the model around rent and the amount of debt you need to buy in a house in New Zealand, it almost just doesn't make sense. However, we've had a huge drawdown in the property market in New Zealand, and if you owned outright, maybe, you know what I mean? Because then not paying. I guess I hate it less as time goes on. However, yeah, there are obviously many more productive ways in which you should potentially be looking at allocating capital. I think property is a very productive asset. And we don't really know what the right price for New Zealand property is. And I think it also has the headwind that it's in New Zealand. It's in the New Zealand dollar currency, and the New Zealand dollar currency has been so weak.
Yeah.
So I think that systemic problem with the currency is it makes property less appealing, because it also has to fight against currency devaluation and relative underperformance against the US dollar. So I think that's a bit of a headwind. But yeah, I mean, I go, look, there's been a big drawdown. That's interesting. That's got to be interesting. If you can find value beyond, you get a 20, 30% drawdown, and then you've got a house that needs a lot of work and you can add a lot of value to, and you can buy with cash, but that's kind of you're bringing value by renovating, right? But I mean, that seems to be there's a lot of margin of safety there. But do I want to be long property with a shit ton of debt? No. That's my but that's my bias. I don't like debt.
Yeah. Yeah. Yeah, I mean, just in the last week, it's like water pipes and breads come along.
Yeah, that.
And before that, it was a heat pump. And
Yeah.
man, it's just like, really?
Yeah, so, like, if you can delegate it off, like, like something like, Buffett just bought Google this week.
Yeah.
That's now in his top 10 of his portfolio of the Berkshire Hathaway holdings. Like, I like Google. I think that, like, the idea of a productive business is interesting. The idea of a cafe that's productive and profitable and, like, I think everyone needs to think about, okay, like, what are the assets I have? How much do they represent in my portfolio? Is there any sore thumb? Is there this elephant in the room that's massively too big and it actually means that the other components of your portfolio don't matter? So, for example, if you're 95% property, you basically have everything rides on this one thing, and you better make sure that it works, right? Because, and it makes wealth management impossible, right? Because you basically then, you have to hide it. You have to actually almost ignore the property in that case, or the asset in that case, and say, okay, well, of my 5% of everything else, what does it look like? And now I need to aggressively build it up. So I don't know. That's kind of my overall view. I mean, it's kind of a bit of a tangent, but yeah.
Yeah. I think, I mean, it just comes back to the whole diversified portfolio thing, doesn't it? And
Not playing with it, not playing with stuff too much, and then, not having too much on your plate,
yeah,
and then focusing on, like, what really matters. Like, during COVID, was there forced sellers? If you have forced sellers, does that mean the price is reflected is it an abnormal price? We had a liquidity event earlier this year where I know crypto traders that got completely blown out, because, there was this liquidity dump and, like, some of these coins went down like 60%. And if you're playing leverage there, or you're not even leveraged, but you have a stop loss in or something, like, that's hugely damaging to people that are in a situation where they're trading or they're leveraged.
but we know now that the only coin to invest in is Bitcoin, isn't it?
Well, Bitcoin is fundamentally different to all the other cryptocurrencies. So the way I look at, like, an Ethereum or a Solana versus a Bitcoin is that I would consider them more like a Visa network or a MasterCard network or a Steam, or even like an app store, like a Apple App Store. So,
And Bitcoin is Apple.
doing different, well, no, Bitcoin is gold,
Yeah.
right? So, Ethereum might be the Apple App Store of cryptocurrency in the future. Or Solana might be. I don't know. I wouldn't say that I'm very bullish, kind of speculating on crypto networks. However, I mean, I'm seeing real evidence that, there's more stablecoin adoption through crypto networks. So that means money rails are starting to go through crypto networks, which means that there's going to be some intrinsic value potentially to these networks that are actually moving money and capital around, right? They're creating the mobility of capital. That might have some value. But you probably have to compare it to a Visa or a MasterCard or something like that. And you have to say, okay, like for like, is the market cap of this network, what is it in comparison to Visa? And how much revenue does this network generate versus Visa? That's how I would start to try and think about it. Whereas Bitcoin is competing more with gold or US dollars. And it's more of a belief system, and it's a decentralized, you're completely decentralized system. That's a bit different. So I'd say they're different games.
Yeah.
Yeah, for sure. So, like, what are you thinking over it? Like, so you talk about where you want to, what you're building. Where do you want to be in like 5 years? Like, is there an idea that you have in terms of like what sports you're involved in, what events you're doing? Like, what would be like, I guess, the thing you kind of horizon gaze to thinking about the most, but on a like 5-year time horizon? So kind of close enough where it's operationally kind of foreseeable.
Yeah, I mean, I'm still at a place where my brother helps a lot with, I'm spread very thin. I'm basically just me. My brother does help a lot that he's still got a full-time job. So hopefully, you know, within 5 years, we've got a bit of a team going. I want us to be as global as possible. I think like mine always comes back to comfortable. Like I think you opened with that. Like, how do you be comfortable? How do you execute on the creative vision that you have? Like, that's what excites me the most. I don't know if you need heaps of capital necessarily to do that. But I want to be doing interesting things in interesting places and making as much impact on as many people as possible through sport and performance. So like, yeah, I don't know. I think that's that question. I always get stuck on it because I'm like, how long is a piece of string? There's how much can you actually achieve in 5 years by yourself versus do you need to raise money?
What do you, sorry to interrupt, what do you, just interested, what do you think of like a Lululemon then?
Well, I think they're a great example of not knowing who they are anymore. I think their stock price reflects it. I think there's an opportunity if I said to myself, we could come in and be a new golf-focused Lululemon, like they obviously started in yoga, right? Servicing women with black yoga tights and going for that affluent New York yoga woman. We could do the same thing for golf, but be probably slightly edgier and a little bit more focused, and you could probably take a good run at it, I think. But then you go, would you ever want to be a public company? How big do you want to be? Like, I look at these brands and subcategories like Satisfy Running and District Vision or Roller Hiking, and I'm like, they look like nice sized businesses, like doing really cool stuff, but not too big. And I've got no idea internally what their discussions are of how do they want to be the next Lululemon. I don't think so. But yeah, I think for Lululemon, you know, Allbirds is a fascinating case study, you know, and I think probably a lack of focus on brand, like when I talked about just the meta, getting stuck in the meta wheelhouse, which we kind of did a little bit at Les Mills as well. But yeah, I think who was the other one? Under Armour's almost dead, you know, is another good example of like,
Do you find that these brands just can never find their way back?
I don't know, like I think we're at that place of can we? I think I would, because Nike's been flat too, right? So I would never bet against Nike.
Well, I am thinking, yeah, like I get intrigued by the Lulu story because it was something that I thought was obscenely overvalued and worth a punt on the short side. But now it's kind of been like value territory, you know, where you're like paying a very reasonable like piece of your buying. I'm looking at it like, what are the catalysts? So like the founders getting back involved, and there's a lot of kind of discussion around kind of like take privates and kind of hostile takeovers and stuff like that. So there's catalysts around, and it's trading at like I think an 11 PE. So you know you're getting 11 times earnings on it, and I still buy from the brand.
I just look at it and go, so I think Chip Wilson, did you see the thing the ad he put out, which I think was a great, I bet you that was an internal, what was smarter than, it wasn't just him doing that.
No,
But I do think,
percent of the company, right? And he wants a return from it.
yeah, well, exactly. And I think early days, someone gave me advice of like, think about the products that you use all the time and they're the best ones to invest in, which I don't think that's great advice. It's like, now I would look at Lululemon and I go, well, okay, if I've got 100 grand, would I put that in Lululemon and could I get a 10x on it? Or am I actually like put 100 grand into Bitcoin because it's more likely going to get to a million? What is it? Just it's under 100 grand right now. Has that got more potential to 10x? You know, so it's like, where is that? And it's really simple terms because this stuff's really complex for me. But if you go because people look at stock price and all of that stuff, and you're smart enough to understand that. But I'm like, and when you use like Bitcoin, using it as a reference to gold, what's gold, 3 trillion or something right now?
It's a lot much larger than the Bitcoin.
Yeah, so whereas Bitcoin could take over that. So from there, I think in itself as a 4x.
Bitcoin can win market share from a gold, but it could win market share from bonds potentially, and it could win market share from money. And of course, I guess in a way, equities as well. It's like you say, it's a diversification approach. I think a Bitcoin versus Lululemon, it's a completely different race.
Yeah, I'm just using them as an example, but I'm like,
It's an opportunity cost question, I guess. But I also think it's a margin of safety question, right? Like your appetite for as you buy an investment, you're also buying volatility.
Yeah.
And that mark-to-mark volatility is often your opportunity. The reason I think that kind of often private equity and venture and on the averages, like when you look at everyone's, not when you look for the best people, because the best venture guys are great, right? And they have, they build great businesses and they do a great service for the country or the world, right? But often basically private assets that aren't marked every day are the most annoying when you have a problem, because they're hard to get out of, they're hard to price. So like, you get a property, okay, the volatility is not that high. You're not getting, say, drawdowns as you would in a Bitcoin, but you don't know because the market's not liquid enough. You're not getting priced on your house every day. You're not getting a real price on it.
Yeah.
So it's hard. You don't do those swings. You get a real price on Bitcoin.
Yeah.
The problem with Bitcoin is, of course, you don't have that depth and liquidity, and it goes very quickly. And because the crypto industry uses so much leverage, and it's very unregulated.
Yeah.
That creates issues.
Yeah. Yeah, but I think going back to like the sportswear industry, it's such a fragmented. You do jiu-jitsu, right? I don't know. Is there anything in brands probably are popping up in a space?
It was a brand built in New Zealand, but they basically sponsored the top guy, and the top guy won a bunch of stuff, and then the brand is like solidified.
Well, I think the shift that's happening is like more challenger style brands, and then the best ones are like you go take the athlete like Tiger Woods. Now he's got his own. He's left. How did that happen? How did he leave Nike? Is beyond. He's a Tiger Woods building at Nike. How does he not be an athlete for life? Because he realizes he could make so much more money owning the whole company himself. And so I think that's where we started off. The distribution channel is the athlete now, and with all their content and all their, so yeah, challenger and niche style sportswear brands that are really like niche down.
Yeah.
And potentially as athlete driven. And if I was a pro athlete now, I wouldn't be going at Nike. I'd be going, how do I build a team around me to create my own, like Roger Federer did with On Running,
Yeah, Beats by Bray, right? And originally,
another great example of it, Yeezy, yeah, which didn't necessarily end well, but you see the power of celebrity and culture.
Oh, yeah, and then you look at what Logan Paul's done as well with Brian.
All of them, yeah.
And
That's fallen off bad. Okay, yeah.
Brian Aston's baggy. And then obviously McGregor had the whiskey.
Yeah.
And that's what made him that's what made him close to a billionaire. Like, that was his big.
And it's always product, right?
Yeah.
Look at Kim Kardashian, look at what's the other one, Hailey Bieber, or what really gets into that with Kanye as well. It's not music. It was Eddie, as well as the Yeezy brand.
Sport, the art or the work got them to the dance, right?
Yeah.
And then they're able to productize something that then just kind of lived on, the George Foreman, right?
Yeah.
Well, thank you so much for coming on the pod. I really appreciate it.
Yeah, awesome.
Thanks, mate. Awesome.